Welcome back to Give Me Some Truth. Today we have Syl and myself, Clint, in the booth. And we're going to talk a little bit about market conditions and specifically about your 2025 market outlook. I won't even call it a blog because it's so long form, but I'll call it near white paper blog post. But so basically, want to plug the market outlook. Definitely check it out if you get a chance. It's like 50 pages of just a lot of content, and we made it fun this year. We went in and did a Trivial Pursuit type of theme, and we have cards that flip with trivia answers and all kinds of fun items inside of a lot of topical information that I think people can take a lot out of. And particularly your article is always kind of the flagship market commentary article and where we see ourselves in 2025. So the first question I want to ask you, because people can go read the article for themselves, but has anything changed between when you released the article and now in your viewpoint?
Not necessarily. I mean, I started working on the article, a while ago. So I think quite a bit has happened since. But nothing that's really changed my views. I mean, we've had a little bit of a sell-off, obviously, in December. December's been a bit of a rough month, but it's nothing that really changes my view. I talk a lot in the article about how it's very much a momentum-driven market, led by, a small number of tech stocks in particular. I think the same dynamics are still very much in place. And so I don't really think there's been anything dramatically different, anything that really would have changed my perception since we released the article. No.
I think that one piece of narrative that has changed has been the bond market. As we sit in kind of mid-January, I feel like there's been a big shift in what people believe in the future of interest rates. And I don't know if that has anything, really doesn't have anything to do with your article. I know your article is more focused on equities versus the bond market, but I think the fixed income and the bond markets, we're looking at higher for longer. It seems like we've changed into that area now where everyone's saying, oh, we're going to have, really high interest rates and inflation is back.
Yeah, I think there's a little bit of that. What's been interesting, I think you and I talked about it a little bit last year. We talked about the Fed cutting interest rates and what does that mean for the bond market. I think we had a podcast on that. And what's funny is one scenario that we had discussed was the possibility that as the Fed would cut short-term interest rates, that long-term interest rates would not come down, but could hypothetically actually go up. And that's exactly what we're seeing right now, is we're seeing the Fed cutting interest rates, but we're seeing the long end of the bond market actually sell off, and so interest rates go up. So we're seeing this steepening of the yield curve that I think has been very interesting to watch, because if you were looking at interest rate cuts as a reason to be bullish on bonds, that's not proved right. But I think now we're looking at a situation where you have the 20-year U.S. Treasury yields at 5%. That I think it's starting to look kind of attractive. I mean, 5% guaranteed for 20 years. I think there's certain categories of investors who would happily take that.
I would agree with you. And, I actually think that maybe we're ahead of our time. The market outlook that we published before that was kind of a back to the future, saying more of a normalization of interest rates and things like that. I mean, when we look at the 20-year around 5% now, that's fairly normal now.
And I love the term normalization, because that's what interest rates should look like, right? We've kind of gotten used to this 1.5% interest rate, in the pre-COVID era. And, for a long time, people were like, well, is this a new normal? Now this is the old normal, right? This is a healthy economy is not supposed to have 2% 30-year interest rates, right? That doesn't seem right. So I think 5% is actually, if anything, it's more normal. It's more what we're used to. So certainly nothing wrong with that. I think inflation is part of that story. I also think if you look at tips break even, so the difference between inflation protected bonds and nominal bonds, that has gone up a little bit, but it's still very much in range. So I think inflation expectations are part of the story. I also feel like it sounds like a lot of people are increasingly expecting the Federal Reserve to keep interest rates at a pretty, like you were saying, normal level, right? I think part of the message that we're getting from longer dated bonds is that the Federal Reserve is probably not going back to a 0% interest rate policy anytime soon.
And we're also probably unlikely, despite the fact that there's been some talk about policy changes and Doge coming in and making all sorts of efficiency changes, that it's probably not likely that we're going to see a whole lot of austerity coming in through policy. We may see pockets of austerity, but I mean, we're still likely to see elevated governmental spending in all likelihood. Maybe you don't share that view.
No, I think that's probably right. I would expect that there will be a few headline grabbing, initiatives that are going to look like austerity, but I think it's in aggregate. I also struggle to imagine that we would have true all-out austerity. And, the beauty of, being here in the United States is the U.S. doesn't really need to do austerity because, the bond market loves treasuries and international buyers are going to continue to buy them. And there's still surplus countries around the world that, need a home for their money and their surpluses. And that home is still the US dollar and the US treasury market. So unlike, European countries, back in 2012 had a real sovereign debt crisis type situation. The US hasn't had to deal with that. And I don't think it's going to have to deal with that anytime soon. So we can get away with not doing austerity, I think, for a lot longer than a lot of our international peers.
I would agree with you. And also looking at that, it seems like every time that there's a big shock to the system, whether it be, a 2008 event or what have you, it seems like then everybody goes and piles into treasuries for safety too.
Absolutely.
And an oddity. So there's a lot of other places to go to inside of there. Now back to some of the themes of your articles. I mean, you mentioned AI a bunch in your article as well, and obviously that's been on the mindset of a lot of different people. Do you foresee this AI, is this an AI bubble, or is this an AI situation where we're going to see some hiccups along the way, or do you see it just being this game changer that everybody kind of says it's going to be, and it's never going to stop, and it's going to be parabolic?
I mean, look, AI is probably a bubble, right? But like bubbles are good, right? I mean, bubbles are kind of how we adopt new technologies. They're part of prize discovery. So I do think it's that some elements of it, we'll look back at it and we'll say, well, that was probably a bubble, right? But I think this bubble will also leave behind a lot of the critical infrastructure that we're ultimately going to need for true, groundbreaking AI implementations that are going to come in the future. I'm super excited about AI. I'm super bullish on AI. I just think there's a big difference between adopting AI as a technology and, markets going parabolic on the back of it, right? Those are two completely different things. The internet was a bubble. It still changed our lives, right? Again, I think the people who thought the internet was going to change everything in the late 90s, they were right. They just, didn't understand how that played into, capital allocation and asset class returns. And what we had in the early 2000s was actually a lost decade, right? Where we had terrible returns for a very, very long time. And so if you look at market history, I think there's lots of examples of people confusing technology and technological adoption with just, continued strength in markets. If you really want to go far back, you can read about a stock market frenzy in the late 18th century, the late 1800s in England, having to do with railway stocks, where people went crazy at the very beginning of the development of the railway system in England, and started speculating on the price of those stocks, and eventually the bubble burst, and was followed by a couple of decades of just absolutely terrible performance by those same stocks. What was interesting back then is it was only after the bubble actually burst that the railway system actually started being built, developed, and people and goods actually started to use the technology to move around. And it's just like it was this complete disconnect between the time when the technology was actually getting adopted and the time when those stocks actually performed. So it's kind of like, if you look at history, there's it's not uncommon for this disconnect to exist between market returns and technological adoption. And so I think nowadays there's probably a bit of a risk that people are just assuming that everything that AI 5 years from now is still going to be just the same as it is now. It's just going to be NVIDIA making a lot of money because they do all the computing hardware and nothing else will matter. I think there's going to be new kind of paths for the development of AI. There's going to be new hardware being developed. And, I think the landscape is going to look very different. And I think also market returns are not always going to be driven by AI.
Yeah, I couldn't agree more with that. I think there's probably a day of reckoning where we'll find out who the pets.com of AI is. And I also believe that I'm equally as bullish on AI. And, I think we see some microcosms of some of that as we went along. You see all the run up of talk about blockchain technology, and now it's seemingly gone kind of dormant, but it's everywhere. It's being implemented all over the place. It's just not catching the sexy headlines and the infrastructure. And I felt like there was a mini bubble there. I felt like there's been a bubble going on in self-driving, and I do think in the next few years, we're going to see like legitimate, real self-driving. And it just happens in fits and starts. They have to they get up to a plateau of technology, and then they have to burst through that plateau. And I think we're in that moment. They're talking about, I just read the other day that Hyundai, I think it's their Ioniq car series, is like up to level 4 self-driving, which is really high. And what a futurist said that I saw someday is like, you don't want level 1 or level 2. You're just a tester. You don't want to go through that. But when you get to 4 or 5, you're in great shape, because that's when the actual technology is safe. So we've had a lot of tester drivers driving around Teslas for a long time and gathering all that data together. And so I think we're very close to full self-driving. And there's other things that are important. Just because they can do the technology, though, doesn't mean it's going to make money. You see all these EVs and you're like,
it's true. And
wow.
The other aspect of this is, there's going to be a lot of creative destruction, or whatever you want to call it, if AI gets implemented, right? There's a lot of companies that are doing things now that won't be relevant or applicable to a true AI environment. And, so people see the upside now and all the good things. There's going to be some pain along the way. And so it's going to be this balance of all the great stuff that's happening and the success stories from companies that are able to position themselves. And, there's going to be a lot of companies that are going to disappear as well, right?
And a lot of jobs. I think the story that's not being told right now is that, and I think it's just starting to begin, is that white-collar workers who've been largely absent of some of these job disruption items are going to be right there with AI, and you're going to see kind of maybe not a hollowing out of jobs there, but you aren't going to see as much hiring there, and so some of these white collar jobs are going to kind of evaporate, and I do think that that's going to provide a downside capture to that, and also efficiencies as well. So you've got both the sides of the coin. If you're a stock investor, what do you want? You want your company to be lean and manage expenses, and that's a good thing from a stock investor. It's a bad thing if you're a person that had just lost their job because AI has replaced you.
Right. And well, what's interesting is, and I talked a little bit about it in the article. I don't think the disruption to the job market have really started yet, right? I think there's going to be a lot of that, but I think, it's barely now just starting. I think there's a little bit of softness in the job market in the U.S. We're starting to see the unemployment rate go up a little bit. I think job creation is slowing a little bit as well. We got some pretty good numbers recently, so people are getting excited. But the trend is still in place, and there's some softening there. I think if you look at job creation numbers, increasingly the main sources of job creation are areas like government and healthcare, which are sources of very very high quality jobs, but they don't necessarily speak of they're not a sign of a very dynamic economy. So I think there's some softness in the job market, and I don't think AI alone can explain it. I think we're dealing with a good old-fashioned weakness in the job market at the moment. It's still, the signs are very subtle, so it's not something that a lot of people worry about, but it is something I'm watching pretty closely.
And just a situation too where client conversations have been interesting lately because people aren't aware of the bond sell-off that kind of happened late last year, and then they look at these companies that have largely driven rates of return, and they kind of expect this all to continue. It was a nice year last year in the markets, and I don't think that people are necessarily prepared for a year or two, or in the tech bust, it was 3 years in a row of down markets. It could happen, and I think people have very limited history knowledge when they look at back markets. This has been a nice run, and we're probably due for a little bit of an old-fashioned pullback. I mean, COVID was that was just a shock. That was something completely unexpected, but an old-fashioned garden variety recession or slowdown, it's very possible, and it's probably sooner than we think.
I mean, I agree, and it's true that COVID was just a blip. I mean, before you knew it, it was over, and markets had recovered. So really, I mean, you'd have to go back to 2008 for a true, a proper crisis, right? And it's true that even a lot of investment professionals have not actually experienced 2008, but you and I did. So this market it's a strange market, right? Because it's so incredibly skewed, and there's so few stocks driving this market, and there's so little breadth in this recent rally. If you look at the headlines, the S&P 500 is doing great, but if you look at certain sectors of the economy like healthcare, healthcare sector returns were actually down in 2024. So it's kind of like the market as a whole is driven by a few stocks, but there's a lot of stocks that aren't doing well, that aren't performing. Anything that's kind of value oriented is struggling. So I don't think that's a very encouraging sign. I think, and I've been pretty bullish about stocks for a long time, as you know. But one thing I've been kind of hoping to see was just more breadth and just a broadening of this rally. And, we've not gotten that. If anything, we got the opposite. Mm-hmm. And this kind of skew in the market, this divergence is, getting to be just increasingly pushed into extreme levels. So I think that's another sign that's very concerning. I think if you look at the data, I mean, you'd have to go back to the late 60s to find a market that is so heavily skewed towards a small number of large cap stocks. And, back then it didn't end well. So, you look at the market being so skewed, you look at valuations being so high, and, investors are very confident, very positive. One of the the bits of data that I quote in my article is there's a consumer survey, the Bloomberg Conference Board survey, that is a very long-running survey. I think it goes back to 1987, where they just ask people, do you think the market is going to be going up in the next 12 months, right? Very simple question. And I think if you look at the survey historically, like the average people don't really have a strong view about the market. And about 35% of respondents typically say that they think the market's going up. Right now, I think that number is at 56%. And that's the highest it's been ever since 1987. Even in the late 90s, that number just breached, I think, 50%. Wow. But it wasn't as high as it is today. So I think we're in this environment now where, it's nobody's allowed to be bearish, because if you're bearish, you probably just don't understand AI, right? So I think it's there's a risk there of just complacency, right? I think it's stuff that we're watching closely.
Yeah. Well, great. Well, thanks for taking the time, and thanks for taking the time to read the market outlook. To all of those that have, if you haven't, please check it out. You can read Syl's article. There's many others out there, and we'll come back to you with more episodes. Give me some truth.
Walkner Condon Financial Advisors is a registered investment advisor with the SEC. Registration with the SEC does not imply a certain level of skill or training. The opinions expressed by the participants of this podcast are their own and do not reflect the opinions of Walkner Condon Financial Advisors. All statements and opinions expressed are based upon information considered reliable, although it should not be relied upon as such. Any statements or opinions are subject to change without notice. Information presented is for educational purposes only and does not intend to make an offer or solicitation for the sale or purchase of any specific securities, investments, or investment strategies. Investments involve risk and, unless otherwise stated, are not guaranteed. Information expressed does not take into account your specific situation or objectives and is not intended as recommendations appropriate for any individual. Listeners are encouraged to seek advice from a qualified tax, legal, or investment advisor to determine whether any information presented may be suitable for their specific situation. Past performance is not indicative of future performance. Thanks for listening, and for further information, please visit WalknerCondon.com.